So what we'll do is have 20 minutes of Julia, then 10 minutes of discussion on that paper, then we'll move to Jesse's paper, and then finally Sukaina, your paper. Each have 20 minutes and then 10 minutes of discussion.
Okay, let me see if I can. I'm gonna put this on presenter view. Okay, do you see?
Yeah, looks great.
Great.
Okay, I'll give you a warning after 15 minutes and then when you have 1 minute.
That's great. Thank you very much for that. All right, I'm also going to have my own timer so I can keep track and hopefully make it within the 20 minutes. So hi, everyone. Sorry again for those of you who had some trouble signing in. My name is Giulia Mascagni. I'm Research Director at the International Center for Tax and Development and the Research Fellow at the Institute of Development Studies. And this paper is joint work with Fabrizio Santoro, who is also from ICTD and IDS. So the title is slightly different from what you have in the program, but it's the same paper. It's called The Tax Side of the Pandemic, Compliance Shifts and Options to Fund Recovery in Rwanda. And apologies for the slight mix-up on titles, but the contents are going to be the same. Okay, I don't seem to be able, oh, here we are. So that's the outline of what I'm going to be talking about today, but let me dive straight into motivation, data, and context so I can try to keep to the time. So the motivation really is that there is much new knowledge on the impact of the COVID-19 crisis. And I think we all struggled, I think, to keep up with the sheer amount of work that has been coming out in the last year and a half. But there is quite little on taxation, and especially on taxation in low-income countries still, in the context of the pandemic. Yet this matters greatly because obviously tax revenue is projected to decrease during the crisis, and I'm going to tell you a little bit more about that later. But at the same time, financing needs for governments are higher than ever. So on top of the already huge financing needs they had before to fund development strategies and programs, there is also now the need to fund crisis response and recovery. So some questions remain unanswered, and I'm going to try to address them today. The first one is, did the crisis affect perceptions around tax and how? And this is really an empirical issue because it could really go both ways. So, you know, the crisis could potentially make taxpayers feel more willing to comply because it's now clear to everyone how important public services are, and particularly healthcare. So they might now see the value of paying taxes because they make that connection. On the other hand, they might actually feel that paying taxes is an additional burden at an already difficult time. So they might feel less willing to pay taxes. So it could really go both ways on perceptions. Similarly, how did the crisis affect compliance behavior and how? Similarly, it could go in both directions. And then on a slightly different angle, how are low-income countries funding crisis response and what are the reform options? So to address those questions, our main tool is really the Rwanda National Taxpayer Survey, which is a nationally representative survey of over 2,000 small and medium firms. They're all registered for business income tax with the Rwanda Revenue Authority, so that's the RRA. And although they're registered for business income tax, some of them pay VAT, and they also pay other taxes that they're liable for at the national or local level. We collected the baseline data in January, February 2020 in person, in a world where COVID-19 was not a global pandemic and was certainly not very much a Rwandan problem yet. We had 8 modules with the sort of standard stuff that you normally collect in surveys, and importantly, tax compliance attitudes and perceptions, which is what I'm going to focus on for part of the presentation today. Then after the baseline, we followed up with 3 rounds in May 2020, September 2020, and February 2021. Sorry. So this was now a world where COVID became a problem in Rwanda. It was a global pandemic, so the surveys happened by phone. It is on the same sample, so we have an unbalanced panel. So as it is quite common for those high-frequency surveys, we had quite a bit of attrition. So the fully balanced panel with baseline plus 3 follow-up rounds would be 84% of the sample. But still, for everyone in the sample, we can have an unbalanced panel where everybody has at least baseline plus one follow-up. And that is what we're going to be using today. The follow-up rounds, we tried to keep the questionnaire shorter, exactly to try to minimize attrition. So we repeated the questions on attitudes and perceptions, and we added some crisis-specific questions. So around, for example, access to relief or support for various funding options. And importantly, we can match the survey data with administrative data from business income tax returns, which is what we use to observe compliance behavior. So this is a timeline of the pandemic and data in Rwanda. So as I said, the baseline is in a world where there was no COVID case in Rwanda. Around mid to late March, the first case is confirmed, national lockdown starts, and a tax relief package is announced. In May 2020, our first follow-up is right after the lockdown has just ended, after 6 weeks. There are then a few months of softer restrictions, which is when we collected the second follow-up round in September 2020. In January 2021, again, a spike in cases, which sparks another lockdown, only in Kigali this time, the capital city. And it's towards the end of that lockdown that we collected the third follow-up round in February 2021. Sorry, it should say February 2021. So the Rwandan context really focusing on the pandemic response. So what we are seeing in Rwanda, like in many other low-income countries, is quite quick and strict reaction as soon as the first few cases appear. Case numbers remained quite low, at least compared to high-income countries. Again, this is quite common across most African countries. But then there was quite a quick government reaction as soon as a few more cases appeared. And in addition to the restrictions, the government also provided some general support and tax relief. So in the first follow-up round, about 70% of our respondents received any support, and 40% received tax relief. Generally, people were quite happy with the government response. So 80% rated the government response at least 8 out of 10. So pretty good, really satisfaction with the response there. In terms of the economic impact, again, quite severe. 2/3 of firms stopped operating entirely during the national lockdown. Sales dropped by 85% during that first national lockdown. And they only recovered to 53% of pre-crisis levels by February 2021. So pretty dire economic circumstances. So let's see what happens to compliance attitudes and behavior now, which is one of the key results. So this is what is at the back of the results that I'm going to show you in a second. So it is a regression where YIT is perceptions. I have 6, I'm going to tell you what they are. And really, the only thing you need to know is we estimate this with survey data. It's a panel, so we use a fixed effects estimation. And what I'm going to be interested in, and what I'm going to show you in a few pictures now, is the coefficients beta 1, 2, and 3, which really show whether the perception of interest increases or decreases at the various stages of the crisis corresponding with the data rounds. So those outcomes of interest are unfairness, so agreement with the statement the tax system is unfair, trust, whether they trust the RRA acts in the interest of taxpayers like them. Then we have 2 indicators of conditional and unconditional compliance, which really are the same thing, two sides of the same coin. So we ask taxpayers to choose between 2 statements, whether taxpayers must pay their taxes to the government regardless of the quality of public services, or whether taxpayers could refuse to pay taxes if they are not receiving public services of adequate quality. And the 2 indicators show agreement with either of those statements. And of course, one is going to be exactly the mirror image of the other. Then we have another indicator on unconditional compliance, which is whether they think it is never justifiable for people to not pay taxes on their income. And finally, an indicator of financial constraints, showing whether taxpayers think that if they are in financial distress, it is quite justifiable for them to declare less income in order to pay less tax. So I'm going to show you 6 graphs for those 6 indicators, and here they are. So each one of these shows the coefficients beta 1, 2, and 3. The dotted line is the baseline level, which is the excluded category, the one against which we evaluate the other coefficients. And each one is a separate regression where the outcome variable is the one that is mentioned at the top of the graph. So for unfairness, there is quite a big drop in people thinking the tax system is unfair. So this can be seen as an improvement. And the drop in perceptions around unfairness is about 40%, which is quite large. There is an initial decrease in trust, which then goes up and goes sort of back to baseline level by round 3. Never justify, this is sort of an unconditional compliance attitude. It increases in the first round, but then it really goes back to its baseline level. Conditional and unconditional, here we see a clear shift that is persistent over the data period. So you have an increase in conditional compliance and a corresponding decrease in unconditional compliance. And as I said, these are the two sides of the same coin, or the same question, really. On financial constraints, a decrease, meaning people feel like it is less justifiable for taxpayers to declare less if they are in financial distress. So what is this? What is this telling us? Really, the two big shifts we see here is an improvement on perceptions around fairness of the system, and then a shift from unconditional to conditional compliance. And this is consistent with the never justify result, where we basically see a bit of an increase, but then nothing much over the course of the crisis. And if anything, an improvement in compliance attitudes in relation to financial constraints and distress. So basically, taxpayers willing to be compliant when their tax payments are matched with public services of adequate quality. That is one of the two shifts. The other one is on fairness of the tax system. The next question is whether those shifts translate in compliance behavior, because of course these are only perceptions. And to do that, we estimate this equation. I'm not gonna describe it in detail, but it's basically here what we're using is the administrative data from income tax returns. It's a difference in differences framework. And we exploit the fact that COVID appeared in Rwanda during the declaration period for CIT and PIT, which are both business income taxes. So we use a cutoff date of 24th of March, and that is the date when the tax relief package was announced and applied. And that we choose that date because it's the date when the crisis becomes very salient in tax terms, as well as in other terms. Basically, it doesn't matter very much if we choose the 24th of March cutoff, or the 21st, which is when the lockdown starts, or the 14th, which is when the first case starts. So we do all of those things for robustness. If I go back to the timeline, basically, we have the declaration period between 1st of January and 31st of March 2020 for the fiscal year 2019. So this is when firms have to declare. And COVID, as you see, happened towards the end of the period. So we basically treat the ones who filed after 24th of March as sort of treated taxpayers, and those who filed before as not treated, because what they're doing is they're filing their declarations in a world where at least COVID is not a Rwandan issue. And you can tell me if this sounds wrong or a bit too much of a leap, but it would be the case that if you had filed before at least the 14th or the 21st, I think nobody really knew what was going to happen yet, or most people wouldn't. So that is how we identify this. So this is the framework we're using, and the coefficient of interest is the interaction between the 21st of March and the year. And we really only expect, if anything, a significant coefficient for 2019, which is corresponding to the declaration period in 2020. Important thing to say is that this is definitely a compliance effect, because economic activity for 2019 has already happened by the time of declaration, and there was no COVID at that point. So it's a pure compliance effect on self-assessed tax liability as reported by taxpayer in their declaration, which is why IT our outcome. So these are the coefficients on the interaction term. So what you see is that coefficients from 2012 to 2018 are not statistically significant. That is a good thing, because it essentially means that there is no difference in trends between those who filed before or after the 24th of March, which is the case because 24th of March didn't mean anything in years prior to the pandemic. But in 2019, fiscal year 2019, so those are declarations filed in 2020, we see a big jump in tax payments only for those who filed after 24th of March. And again, same result if we take 21st or 14th of March. This effect is quite large. It corresponds to about 2/3 of the average tax liability of 2019. So that is massive. So when we try to see why that is the case, we try to do this by quintiles, and we see that it's really, the effect is largely driven by large taxpayers. So again, the fact that it's such a big effect size is sort of consistent with that. So I'm not going to summarize results so far because I want to try to get to the end within the 20 minutes. So let me press on to a slightly different angle now, and I'm going to try to put those two together towards the end. So now I want to talk about options to fund response and recovery in the context of the crisis. So the question is, how have low-income countries funded crisis response and recovery? And the background, of course, is that there was quite a sizable drop in tax revenue from an already low base. So the tax to GDP ratio in Rwanda is below 15%, which is what is generally used as an indication of the minimum that you need to really have a functioning government with public services accessible to everyone. And it is a bit of an arbitrary threshold, but it's just to give you a sense. So in separate work has shown the decreases you see there, 25% drop in CIT revenue, at least 5% on VAT revenue, and likely larger losses in trade taxes. So in a context where tax revenue is lower, what other sources of revenue fill the gap, and what are the reform options to increase tax revenue? And here,
you have just about 5 minutes.
Okay, that's perfect. I think I'm going to make it in 5 minutes. So we have no baseline for many of the crisis-related questions I'm going to show you today. So that means that the analysis is largely descriptive. But let me show you the results right away. So I'm going to start with informal contributions because they are key to understand tax systems in low-income countries. By informal contributions, I mean all those tax-like payments that are not taxes, but that are key to fund development projects and public services at the community and local level in low-income countries. I'm not going to say anything more about this because I think maybe they have managed to join the panel, Vanessa and Max. They're amongst the world experts on this, so I'm going to redirect questions to them. But I'm just going to say that indeed, in the baseline survey, we already added some questions on informal contributions, recognizing that they're an important part of fiscal systems as a whole. And in fact, we find that they are more common than tax payments, even at baseline, although the sample is entirely composed of registered firms. And also they enjoy much better fairness perceptions than formal taxes. So this was already quite interesting at baseline, but what happens during the crisis? So we asked people if they are contributing to new COVID-related projects. So this is on top of the contributions they were already making before. And in May 2020, 43% said they had contributed to new COVID projects. That percentage only increased in rounds 2 and 3. Mostly these are community feeding programs. So the vast majority is this kind of program. But those contributions are highly regressive. And again, I'm not saying anything that others haven't already shown for informal contributions, but it is quite striking to see these are particularly in-cash contributions, which are easier to put in a graph like this with fewer assumptions. And you can see that as a share of income across the distribution, so 1 to 5 is, 1 is the poorest 20% of the population of the survey sample, and 5 is the richest 20% of the survey sample. So those contributions decrease quite dramatically from the poorest to the richest respondents. Yet, fairness of informal contributions, which was already very high, so I showed you it was almost 90%, increased significantly, although by maybe not very many percentage points, but it is a statistically significant shift that persists across rounds. So these are two graphs that at the back of this, there are regressions similar to the ones I showed you before for perceptions. So despite regressivity, fairness is high, and if anything, it increases during the crisis. Now, taking a broader look, broader than just informal contributions, we asked respondents, how should the government fund the extra expenses that are related to the crisis? And we asked them to agree and disagree with various options separately. So the responses are independent of each other, or at least they weren't set up so that they had to rank them or choose between them. So the options are more taxes on everyone, more taxes on the richest, on the largest businesses, on properties, or additional foreign aid or voluntary contributions. And what we're hoping to get from these questions is an indication of public support for tax reform and whether that public support shifted throughout the crisis at the various stages that we can observe with the survey rounds, with the follow-up rounds. So this is what we see. This picture is for round 2. So the two biggest columns are aid and voluntary contributions, perhaps unsurprisingly. Especially unsurprising is the one on voluntary contribution, given what I have just shown you about their incidence and incidence as in how widespread they are and the perceptions around their fairness. Amongst tax options, and we can discuss the aid in the Rwandan context, but I'm just going to abstract from that now. Amongst tax options, the ones that enjoy the greatest public support are taxing the richest, with 45% agreeing to that, and 52% for largest businesses. I'm only showing you one round because there are no big shifts really, if any, across the survey rounds. The only notable one is an increase in the support for taxing the richest more, which goes from 40% to 45% from round 1 to round 2, and it stays the same in round 3.
1 minute.
Yeah, I'm almost there. So this is the last picture I want to show you. When we look at public support for tax options by quintile, so again, from the poorest to the richest, and here I only included the tax options, I think it's quite interesting to see that support for taxing the richest and large businesses decreases with as income increases. So I think this is a confirmation of what one could already expect, that there would probably be quite a bit of resistance, especially amongst higher income people, to increasing taxes on those groups particularly. So I'm going to conclude now. It's my last slide. I'm just going to make a couple of remarks on results and what do they mean for opportunities for reform. So what I've shown you is that the pandemic resulted in some positive compliance shifts. And this has to do with perceptions around fairness, more conditional compliance, so taxpayers demanding better public services in exchange of their tax payments, and also improvements in actual behavior. I've shown you that informal contributions are key in funding crisis response, but they are highly regressive. Yet they enjoy great public support and very high perceptions around their fairness. So maybe there is a case here to do better information campaigns, and certainly for policymakers, especially at the local level, to keep an eye on those informal contributions, because the fact that they're so regressive is quite problematic. What does this all mean in terms of new opportunities for tax reform? Well, the shifts that we see, especially from unconditional to conditional compliance, mean that maybe policymakers can leverage fiscal exchange, so that relationship between public services and taxes, to improve compliance and maybe even to improve trust and equity around tax perceptions and tax compliance. But also they can probably increase equity of tax system by taxing the richest more effectively. And this is something that I could talk on a lot longer, because it is one of the areas where we want to focus a lot more at the ICTD, but I'm just going to stop there, and maybe we can discuss a bit more in with the questions and comments. And of course, this is only about Rwanda, so there's lots of directions for future research, one of which is to try to do this or similar things in other countries to really figure out, is this a Rwandan story or is this happening in other countries too? And we do have another project in Sierra Leone where we find some similar results, some different ones, and certainly more to come. So watch this space for the paper and related research, which is all going to be on the ICTD website. Thank you, and sorry for going a couple of minutes over time.
All right, thank you, Julia. Angela, can I ask you to give comments first, and then we can, or questions first, and then we can open to the broader audience?
Thank you. Thanks, Julia. It's very interesting paper and interesting results. I don't have a lot of comments on it. Few questions to maybe that will help improve the quality of the paper. Yeah, you can hear me very well, right?
I can hear you.
All right, great. So I think the first question I have is about fairness perception. So whether it depends on receiving tax relief, because the fairness question, the post-COVID fairness question, actually includes periods where already tax relief is provided to the taxpayers. So whether the firms that actually receive relief respond positively, because what we are looking on the coefficient is average, right? So if the ones that are receiving, tax relief are responding more positively, that tells us the perception may not be durable after all, because once the tax reliefs are over, it may not be persisting. But if it doesn't depend on whether receiving a tax relief, it may give us more confidence about the durability. So it would be interesting to interact the rounds with the tax relief received of the firms. And that's the first comment I have. On the second comment, I think if you look at across time, how persistent is late filing across firms? So do firms vary the months that they file their taxes, or are the firms that are filing in later, like in the March, always file in March? That may tell us about whether these are type of firms that face liquidity constraint or other things that the firms may be different after all, right? So because if they are similar, it gives more confidence for your defensive strategy. So maybe, describing the filing behavior of firms, ideally it would be like mix of both, right? So sometimes they file in January, sometimes in March. I think that would give us more confidence on similarity of the firms. And also additional robustness that may help is on to compare to narrow the window into around March or something like that, if it is possible. If the sample doesn't really go down a lot, that may give us more confidence about the robustness of the result. And one additional comment I have is I'm a bit confused about the type of compliance variable that's used as a dependent variable. Is it the level, or is it taxpayer as a share of declared income? It's not clear to me, because in the abstract it's a taxpayer as a share of declared income, but later on I think it's actually the label. So it matters actually. And also, if you are using label, what you are saying is, in the absence of treatment, all the firms would have their income or their declared tax would increase by the same amount in Rwandan franc. But that means like a firm that sells 1 million would increase, like, I don't know, 5,000, and a firm that sells 50,000 increase 5,000. I think to avoid that, maybe using a log version of the variable would be appropriate. That means they'll grow in a similar fashion. I think that's probably better ways to use it. And the final comment I have is on the opinion of taxpayers about richer or bigger firms to pay higher tax. And I don't know whether we can learn anything from that opinion, right? Because I don't know whether that differs across period. And even if it is, does it matter in a way? Because at the end, it may not even be optimal or feasible. Say, can you change the tax rate across income tax? I don't know. Basically, that will be difficult to administer and easier to evade. So I don't know how much we can learn from that. But okay, those are the comments I have. Thank you.
Wonderful. Thank you, Anne-Willem. Julia, do you want to respond, or we can take more questions?
I can respond if you want. Shall I try to do that quickly until that's fresh in everyone's minds, and then we move on to other questions?
Sure.
Okay. So I'm just going to respond briefly, and then I mean, we might have a chance to continue the discussion if that's useful. A great point about fairness and interacting with receiving tax relief. We have done that, and the reason why I haven't talked about it is that we don't really see much of interest. If anything, there are some results that are not clear to interpret, but it's not the case that the fairness improves only amongst those that receive tax relief. In terms of the diff in diff, so again, great point. I forgot to say that about 50% file before and after the 24th of March cutoff. So at least we have the sample split really quite nicely between the before and after. Of course, whether they file before or after is related to some taxpayer characteristics. I am hoping that we can still convince reviewers and ourselves and, and readers that we're still identifying something, given that really the assumption that we need is the parallel trends rather than the same level. So even if there are smaller taxpayers filing towards the end of the period, that shouldn't be a problem in itself. Point taken about logs, we have played around with that and then we decided to use levels. So again, we can go back to that. Opinion of taxpayers, again, this could be a much longer conversation, but let me just say that what I have in mind here is not so much things that I change in the tax rate or introducing new taxes. I mean, I think as you will know, this is a lot about implementing better taxes that already exist. And I think enforcement across different tax types and different income levels is very uneven. And but in order to start implementing taxes that already exist and enforcing them effectively, especially when those are taxes that are levied particularly on the better off, even just that, without any change in legislation, requires quite a bit of political support, or could generate quite a bit of political resistance. So I think what those results show is that at least there seem to be some support for the idea of taxing the richest. I think what is interesting is the difference between taxing the richest and taxing property, because in many African countries, actually, the two things are very similar, because we know that property is a key way to store wealth. So I think they can start giving indications on tax reform along those lines. But of course, this is just very indicative, and it's certainly not the end of the conversation.
Okay, we have a sort of minute or so if anyone wants to have another question. Otherwise, we'll move to the next paper. Oliver, go ahead.
Yeah, I'll to follow up on some of those for you, Julia. I think you need to explain your difference in difference a bit more clearly, because in particular, it's not clear to me whether what you're looking at is late filers. You know, what you're showing in your results is that late filers are normally don't pay any more tax than early filers. I suppose the issue, what you're trying to argue is that there's something special that happens about the late filers in 2020, and that they're paying more taxes because of COVID. Now that involves a lot. You know, particularly, essentially their tax liability, even if they're filing late, you know, their performance, their accounts will have already been determined. So it's not obvious that they can do a lot to alter, because you're kind of implying that they made changes in the data they reported because COVID had happened. And I think you need a lot more to demonstrate that, well, that might be the case, because you have a treated and control, but is it the, you know, I suppose one question is it the same firms that file late every year, or is it different in different years? In which case, you know, you're applying the treatment to previous years is a bit more like a placebo than a test for parallel trends. So I think you need to do a bit more to demonstrate that usually there's no difference in tax paid according to firms, whether they file early or late, except in this year. And then you probably need to look a bit further into why there might be a difference. Two other minor comments, smaller comments, is, you know, your evidence that there's an improvement in attitudes is pretty convincing. You could do a bit more to look at the effect of tax relief, because it's surprising that it seems to have no effect or no consistent effect. But the other thing is, this may just be a kind of a a solidarity response that you observe in many contexts. You know, the country's in a crisis, everybody pulls together. And this might be picking that up. And a lot of your other results suggest that's what you're picking up. So it doesn't necessarily have any long-term implications for tax compliance. And just a final comment is, you might want to think a bit more about the regressive nature of voluntary payments or informal payments for a number of reasons. One is, by their nature, these may be like local lump sum payments, in which case, inevitably, they're going to be regressive. And also, you've already shown that larger, well, certainly larger firms or taxpayers pay more tax. They may even pay proportionally more tax. So, you know, and also if these voluntary payments are relatively local, small scale activities, they're not going to be major sources of funding for addressing the problems of COVID. You're still going to need a large scale funding, and that's either tax or aid or whatever, or probably a combination of both. And I suppose the final observation is that, you know, you get the result that one nearly always gets if you ask people about tax. People want to increase taxes that they don't pay.
All right, thank you, Oliver. Mashekwa, I think, can we save your question? Either you can put it in the chat directly to Julia, or we'll save it for the end. We'll try and have some wrap-up discussion then, because we better move to Jesse's presentation now.
All right, thank you. That's fine.
All right, great. Jesse, please go ahead.
Yeah, thanks so much. Let me share my screen. Right. I think you can see this, right?
Yeah, all good. Thank you.
All right, great. So yeah, thanks for everyone for joining the presentation. I'll talk a little bit about our study on the distributional effect of COVID in 5 African countries. And one thing I want to mention up front is that this work actually comes from a collaboration of more than 30 people around the world, both in Africa and also here in Europe, in Finland and the UK. So yeah, this comes from the work of a really big group. Here are the contents of the presentation. So I'll talk a little bit about the background of the study, but I'll focus mostly on the methods and some preliminary results of this work. But let's start with the background. So this study is conducted as part of the Southmont research project at UNU Wider. And in the Southmont project, our main focus is on developing these so-called tax benefit microsimulation models for developing countries and using them for different types of applied or policy-oriented research. I listed here some of the kind of key reasons why microsimulation can be a useful tool in these countries. Another thing to mention is that our work in the Southmont group is very collaborative. In particular, we work with national teams in our partner countries, including teams from the 5 African countries that are part of the COVID study that I'll be discussing here. Also relatedly, the Southmont initiative has a very heavy focus on capacity building. Basically, we provide training and other resources, both for the national teams I mentioned, but also for other stakeholders in developing countries, like policymakers. And finally, all of this work is supported by many other organizations, including SASPRI and the University of Essex, both based in the UK. Okay, so one heavy focus for about a year has been the COVID study that I will talk about in this presentation. So we are studying the effects of the pandemic on inequality and poverty in the 5 African countries mentioned here. We also already have published 2 country-specific studies, both on South Africa and Ecuador, focusing on the short-term effects of COVID in those countries. And we're doing similar research in Vietnam. Then here are the main objectives of our study. The first one is simply estimating the effects of the pandemic on poverty, inequality, and public finances. Second, assessing the effects of different COVID-related tax and benefit policies on kind of mitigating any income losses. And finally, developing the so-called comparative estimates across the 5 countries in the study. Then I'll talk a little bit about our methods, basically the steps in the analysis. We start by developing kind of a counterfactual for 2020. Basically, this is a data set with information on the population and their incomes that reflects what would have happened without COVID in these different countries. So we have these kind of underlying survey-based data sets that we use in the African microsimulation models. They come from years 2014 to 2018. And what we do here is we reweight these data sets so that they match with population estimates from early 2020, just before COVID. And we call these our kind of pre-crisis data sets. We also operate any economic values like incomes and consumption expenditures based on price changes between those earlier periods and 2020. The second step is developing so-called crisis data sets that actually do account for the effects of COVID in 2020. So obviously the different lockdown measures, government restrictions, and so on reduced economic activity compared to this counterfactual or baseline situation without COVID. Our basic approach is to look at how labor incomes changed in different industries, and we proxy those losses by industry level GDP shocks, basically deviations in GDP last year from their earlier trends. And we then translate those shocks to the microdata, and I'll talk a little bit more about that later. The next step is gathering information on these new tax and benefit policies that were adopted in response to COVID, and also incorporating those into the models. And finally, we use the models to estimate the effects of both the pandemic itself and also the effects of these new COVID-related policies. I'll talk a little bit about the different steps, starting with the creation of these data sets that do account for the effects of COVID. So as mentioned, we start with these industry level GDP shocks. Just as an example, this is GDP of the accommodation and food services sector in Uganda. Here we simply predict the 2020 GDP using a linear trend from the 2017 to 2019 period. And the kind of counterfactual prediction for 2020 based on these last 3 years is shown in the blue bar. And to get the shock, we compare this counterfactual to the actual GDP in that industry from data. That's the red bar for 2020. So for Uganda in that sector, the estimated shock is simply the percentage reduction from the counterfactual, which is here around 25%. And at the moment, we have these types of relatively simple estimates for all industries in all of our 5 African countries for 2020. So this is the shock for the accommodation sector I mentioned for Uganda. Here are the shocks for the other sectors we have. Maybe one thing to mention that's quite important to our results is that agriculture has had a very limited impact, not just in Uganda, but actually in most of these countries. You can see that at the bottom of the graph here. In any case, the next step is to translate these industry level shocks to the individual level data. So basically we apply these shocks to the pre-crisis or counterfactual data sets I mentioned to develop so-called crisis data sets. And comparing those is kind of at the heart of the study. So I mentioned this 25% shock in the accommodation sector, and how we move on from here is that we first assume that labor income in that sector is reduced in proportion to that industry's GDP shock. So the GDP reduction is proportional to the labor income reduction. Second, we assign workers in that sector unemployed with 0 income so that the total labor income in that sector is reduced by that same amount. Again, this is just so far been about the accommodation sector, but we do the same thing for all industries that experience a negative GDP shock. And so far, we've only adjusted incomes, but we also need to reduce household consumption expenditures, which we do in proportion to the income changes. This actually comes with some additional steps, which I'll leave out here just to save some time. The next step in the analysis is finding information on tax benefit policies adopted in response to the pandemic. This is something we've done in collaboration with the national teams we have in these 5 African countries. Maybe first thing to mention is that these types of measures have been pretty limited in Africa, which is of course quite different from what we've seen, for instance, here in Finland, where I'm residing. There have, however, been some measures, some of which we've incorporated in the models. Here are some examples. So in Mozambique and Ghana, for instance, utility fees were reduced for consumers after the pandemic hit for several months. Ghana actually had a pretty large number of measures overall, which we have modeled, but as I'll show later, the overall impact of these policies was actually negative on incomes. And this is fully because of a large school feeding program in the country was stopped for 9 months because of school closures during COVID. Then, in addition to these policies in Ghana, another policy for which we already have some results is the emergency social gas transfer in Zambia. This is a benefit that was provided to specific poor households for a period of 6 months. In US dollars, it's about $20 per month per household for that period. And the final step in the analysis is actually running these microsimulation models with different data sets to develop these estimates of the kind of direct impact of the pandemic and also the individual impact of these COVID-related tax and benefit policies. And I'll skip the details here and move directly to the results. So one thing we do is develop these comparative estimates between countries, basically seeing how the impacts on incomes, poverty, inequality differ across the countries. And this requires using these kind of harmonized international poverty lines and also turning all income and consumption values into comparable currency, basically international dollars. And this first figure is mostly just to introduce these graphs. So this is the median disposable income in Zambia in 2020. The green bar shows the counterfactual situation, basically what we get from our counterfactual data set, or what if COVID hadn't happened. The red bar shows the outcome after implementing the income shocks, and the orange bar shows the outcome with the income shocks from COVID and also the effects of the emergency gas transfer in Zambia. So you can see that COVID itself reduced median incomes by around 15%, but only by 9% if you account for the gas transfer. So in terms of alleviating the effects on median incomes, this single policy was actually pretty effective. For the other 4 countries, we have similar estimates that can be compared to each other. For Mozambique and Ghana, also estimates involving COVID-related policies. In the case of those countries, it's the full set of policies I mentioned, not just one, as is the case with Zambia. So as mentioned, in Ghana, these policies actually led to larger income reductions, and this is purely because of the discontinuation of the school feeding program I mentioned. In Mozambique, the COVID-related policies mostly involve small reductions in utility fees, so the additional effects of these measures is not large. Overall, in terms of median incomes, Zambia was affected most, followed by Uganda, Mozambique, and then Ghana, and in general, pretty substantial income shocks. Then, if you look at poverty rates, the effects are a little bit smaller in relative terms. Here we look at the share of the population earning less than $1.9 per day. We see 3.4% increase in Zambia, for instance, after accounting for the effect of this new income transfer, around 2% increase in Mozambique and 1.5% increase in Uganda. Overall, the COVID policies have had a pretty limited effect on extreme poverty, or COVID itself has had a pretty limited effect on extreme poverty, but at the same time, a huge proportion of population has already been below this extreme poverty line, even before the crisis and without the crisis. And these people under the poverty line have, of course, also lost income and consumption opportunities during the pandemic. Here are the effects on income-based Gini coefficient. They are also quite modest, between 0.3 to 0.4% increases using these relative changes. And again, one of the main explanations for these pretty limited effects is that agriculture didn't experience a large shock, and a large share of the population is working in agriculture in most of these countries. And again, there's also the fact that poverty rates, for instance, are at a very high level even without the pandemic. Then just a few graphs with some country-specific results using our decomposition methods. First, this is the reduction of disposable household income in different income quartiles in Tanzania. For instance, the gray bar on the left shows the average impact on earnings of the for the poorest 25% of households. In Tanzania, that is only around 0.2%. And quite obviously, incomes have decreased in relative terms the most in the middle of the distribution. The overall effect is shown by the white dots, and that incorporates any mitigating effects from automatic stabilizers, basically people paying less taxes or getting some benefits due to the lost incomes. Again, those are the light blue bars above the 0% line. And for Tanzania, and actually all of these African countries, automatic stabilizers had a very limited impact in mitigating any income losses. This second graph actually simply focuses on these automatic stabilizers and kind of decomposes these effects a little bit more. Again, the small alleviating effects come from people making less social insurance contributions in the middle and upper parts of the distribution, and also in the top quartile paying slightly less taxes. But if you look at the scale, these effects are pretty minimal. Here's the same overall figure for Uganda as another example. Here the income losses are much larger if you look at the scale, but again tend to focus on higher income households, which might actually be surprising. But again, the low impact on agriculture has a lot to do with this. And if you look at automatic stabilizers, they have alleviated income losses almost only in the top quartile of households who paid quite substantially less taxes because of these income losses. Then for Zambia, I'm just showing the results for the effects of the emergency cash transfer I mentioned earlier. And as you can see, the scale here is pretty large. The bottom quartile, for instance, was estimated to get a 16% increase in disposable incomes on average from the cash transfer. And of course, incomes in the bottom quartile are very small. So this may seem bigger when you look at the percentage change than if you looked at the absolute increase for that bottom quartile. Yeah, that's pretty much it. Let me summarize our findings. So we find pretty modest increases in income inequality and poverty across the countries. The effects vary quite to some extent across countries and also across the income distribution. And of course, quite interestingly, the higher income households in these countries experienced relatively large income shocks as well. And again, one of the reasons was this small income shock in agriculture, where large proportion of the population in these countries work. So agriculture kind of served as a buffer against economic losses, especially at the bottom and middle parts of the income distribution. In terms of COVID-related policies, the emergency social cash transfer appears to be quite effective in alleviating income reductions, especially at the bottom of the distribution. In terms of other countries, these policies have mostly been of pretty limited scale or basically completely missing for some countries last year. Ghana was an example of a country with actually quite a large number of policies, but based on our estimates, any positive effects were kind of shadowed by the discontinuation of the school feeding program I mentioned. Then I talked about automatic stabilizers, which also didn't have much of an effect in reducing income losses. One big reason here is high informality. So many people work in the informal sector and are not eligible for any income means tested benefits. And by the same token, these countries in sub-Saharan Africa rarely have any notable income means tested benefits to start with. One limitation with the study for now is relying purely on these industry-level GDP shocks. Of course, we've worked with pretty limited data compared to many higher income countries so far. And related to this, I mentioned that for now we've used this kind of random allocation of workers within sectors into unemployment. One thing we've recently incorporated in the study is using this new survey-based microdata from the World Bank to actually model these labor market transitions due to COVID in much more detail. So yeah, that's actually the presentation. I'll leave you here with some links. The link at the bottom might be helpful if you're actually interested in using these models yourself. So they can be used with many other things than estimating the effects of COVID. So I definitely encourage everybody to take a look. But yeah, thanks. I'm happy to take any questions.
Thanks very much, Jesse. That was great. Very on time. Oliver, can I invite you to comment first if you would like to?
Yeah, I think I'll only raise kind of 3 broad comments. In one sense, I suppose a general comment is, these models, the estimates of these models are useful and interesting, but in a sense, they're only as good as the data that's used. And I think a bit more, well, maybe in the paper, it's difficult to cover in the presentation, but certainly aspects of that, it would help to have a bit more discussion or explanation. One issue is, and this is particularly important for agriculture, would be to know how the kind of estimates of sector GDP distinguish between volume and price effects. Because, to kind of, in certain respects, it may be true that agriculture overall is the least affected sector, but it would be misleading to think that there haven't been significant effects within the food sector in many of these countries. Partly it may come from agricultural production. More importantly, it comes from trade and transport restrictions. So there'll be price effects. And some of the survey evidence suggests that there were increases in food prices. Now, that can appear okay for agricultural producers, but for the consumers, it's a different effect. And I'm just interested if those types of things are incorporated, or if those types of price effects, that's just a separate issue that you'd have to have different type of analysis to deal with. A second general question, as I understand it, these are effectively models about labor incomes and labor tax payments. But of course, that misses a large proportion of certainly tax in sub-Saharan African countries. As a rough generalization, we know that most taxes are paid by companies, in particular by large companies. Now, that's not that they're paying a lot on profits, but they're employed, they have the highest levels of employment, so they're the most likely ones to be paying PAYE or labor taxes. They pay the most in VAT because they're the largest firms, and they probably pay the most in corporate income taxes. So, and certainly firms pay a lot of tax, but they seem to be completely missing from this. And I'm just wondering, is that unavoidable because of the data, so that you can't really capture firms and their importance in the tax side? And maybe it's just a qualification that you really are just looking at tax benefit from a labor perspective, and in that context, it would be useful to know to what extent do these models, if you estimate tax revenue from these models in some baseline, does that correspond to labor tax revenue in the countries? Just to get an idea for, how well does it capture at least the taxes paid by workers in these countries. They're my only comments. They're just things that, for people who want to interpret the results, they're the types of things we'd like a bit more information about.
Thanks so much. Very helpful questions. Yeah, your first comment about the estimates are as good as the data, that's definitely true. And that's certainly been the hardest part of this work. It has been to find good data, and simply the fact that the kind of original survey data, as I mentioned, comes from years 2014 to 2018, and we do some tricks to get to 2020 estimates. That's already a big limitation, of course, with these African countries. You mentioned agriculture and the fact that we can't really distinguish between volume and price effects. So that's definitely true. Of course, one thing is that if prices change in the downstream in these food industries, or accommodation sector, accommodation and food services, like I showed for Uganda, of course, there the effects are also seen in labor outcomes. But that's definitely a good point. In some sense, using these industry-level GDP shocks is the best we can do in terms of seeing quickly what COVID did in these countries in the absence of better survey data. But for Uganda, actually, we do have access to World Bank's phone survey data, which actually helps us look into these effects a little bit more. But that's definitely a valid point. In terms of the fact that the models use basically only look at labor taxes instead of business taxes, corporate taxes, that's definitely true, and something that's kind of we've been working on a little bit, but at the same time, data limitations kind of preclude us doing much more than we can with this. So yeah, and actually for some countries we do have some corporate taxes, but they are in fact kind of a smaller part of the models than these labor taxes we are looking at. The other point you made about how well the tax revenues we actually model capture what's happening in the real world. Basically, the models are based on these policy rules, what should be paid to individuals in that country based on the rule, based on what they earn and their characteristics. In most cases, these models tend to over-simulate. So they say that more taxes are collected than actually are. So we do this kind of additional analysis where we compare the tax revenues in the models to actual external data about collections. And then we do this kind of dampening. For instance, if only half of the benefits based on the rules are actually paid, then we dampen or kind of downscale these payments in the models, and we get closer to the realistic estimates. But even with that, of course, again, some tax revenue is missing simply from the fact that corporate taxes are much smaller part of the models, and in many cases not modeled. So yeah, that's definitely a limitation. Yeah, just some quick answers. Hope that helps a little bit, but thanks a lot for the good comments.
Okay, great. If anyone has any other questions, you can raise your hand and I'll call on you. Otherwise, we can move to the last paper. Okay. Thanks very much, Jesse. It was great.
Thanks.
Umer, I think you're presenting.
Yes, I am. Just a second, let me share my screen.
Sure.
Is it visible?
Yeah, all good for me.
Okay.
I'll let you know when you've got 5 minutes left.
All right.
Thanks.
Right. Thank you so much for organizing the panel and obviously allowing us to present this work. Just a sort of quick caveat, this is fairly preliminary work that the four of us, Max, Vanessa, and Sukaina, you already know, and myself, I'm Umer. I teach at the Lahore University of Management Sciences here in Pakistan. So this is fairly preliminary work that we're looking at. We're sort of still getting into the analysis of the data that we've collected. And so we're sort of, much of what we present today is going to be sort of exploratory in nature, with obviously some of the descriptive characteristics of the data that we've collected. So just a quick outline of the presentation. I'll start off by giving an introduction to the project itself and the motivation behind it, and go over the research design, and then we'll offer key findings and reflections on 3 or 4 basic themes that have cropped up, and in the way that we sort of also conceptualized this project. So the project essentially, it sort of has its origins in increased conversations around this idea of what actually works in combating the negative effects or the sort of the damaging effects that COVID-19 has had on the economy as a whole, and on obviously on welfare. And one of the conversations that we've seen happen repeatedly is obviously the role of voluntary contributions and charity in general, as well as obviously the role that tax relief interventions, for example, have had in helping people mitigate the loss of income and obviously consumption losses that they faced during this time period. A lot of these consumption losses, some of them have obviously been tied to health-related outcomes, but a large part have actually been tied to public health outcomes, more relating to obviously lockdowns and the restriction on economic activity, especially in different countries across the global south. So one such aspect which has received some attention, though obviously I think, and we believe that it deserves a far greater sort of scrutiny, is zakat as a form of obviously voluntary contribution, or as a form of intervention that has taken place around this time, around this time period. Now, for those who are sort of less familiar with zakat, zakat is obviously one of the 5 key Islamic religious tenets. It's conceptualized theologically as a sort of a duty or a sort of a levy of about 2.5% of all productive wealth. There are some sort of jurisprudential differences between different sects within Islam on how that 2.5% is calculated and what all constitutes as productive wealth. But sort of the rule of thumb that's usually used is that at the start of Ramadan, which is the holy month in Islam for fasting, your sort of total productive wealth is assessed, and a levy of 2.5% is imposed on it. The interesting thing that we feel is worth exploring, and which a lot of this project is also based on, is that there is varying levels of state involvement across different Muslim majority countries as far as the organization and regulation of zakat is concerned. So we know that obviously, that zakat is seen as a religious obligation in many parts of the world. But what we also see is that different Muslim majority countries have actually, have certain levels of state involvement in the way that it's administered and it's regulated. The distribution of zakat itself is, sort of theologically speaking, it was, going by scripture and tradition. There are about 8 categories of individuals that are asked to sort of that the 8 categories of individuals that are designated as being deserving as recipients of zakat itself. Estimates of total zakat collection and zakat donation vary wildly, as the figure here that I've given suggests, but it can range anywhere from between $200 billion to about $1 trillion. What is clear, though, is that if you look at the range of Muslim majority countries where zakat is practiced, either as through state involvement or through voluntary obligation, it is clear that it has an important role to play as far as overall social protection is concerned. So, for example, in the case of Morocco, what we estimates of zakat contributions, for example, are about 3 times that of the state's own flagship social protection program. So there is, I think, certainly room to explore this further. So based on all of that, and based on this context, our thinking was essentially looking at how does tax-based relief, for example, hold up against zakat and charity. During the pandemic, what is the relationship between these different aspects and these different ways of mitigating, obviously, the fallout of the crisis itself? I'll obviously go into more detail about what some of the questions are that we're dealing with here. But broadly speaking, what we see and what makes zakat, I think, particularly interesting to study is that we see sort of varying conceptualizations. So we've already spoken about the theological conceptualization, which, while there are sort of sectarian differences in terms of how zakat is managed, especially between obviously the Sunni and the Shia sect within Islam, but even within different sort of Sunni juridical traditions. What's also interesting is that in different countries we see zakat taking the shape of, in some places, the shape of taxation, where it's legally enforced, collected, and administered by states to fund social expenses. So off the top of my head, Libya, Malaysia, Pakistan, Saudi Arabia, Yemen, and I think Sudan all have sort of a mandatory collection of zakat that is administered and regulated by the state itself. And then on the other hand, you also have a range of other Muslim majority countries where zakat is seen as charity, where it may be voluntarily administered and distributed by individuals themselves, with little to no state involvement. In some cases, for example, in the case of Egypt, there is the existence of a state fund, but contributions to it are voluntary in nature. So there are interesting contrasts that were drawn here as well. So in those countries in particular, zakat resembles more as charity rather than a form of taxation, and it takes the shape of taxation in countries where you do have a mandatory enforcement of collection and administration. The extant literature is actually also ends up serving as a source of motivation to go deeper into this. Much of the literature on zakat tends to look at it as a social protection, poverty reduction instrument. There's a quite a considerable amount of work that focuses on these two particular aspects, and there's additional work that from within the tradition of history and religious studies, which looks at the role of Islamic jurisprudence in shaping, defining zakat in particular, in debates around exactly how much of how is zakat a obligatory, b what sort of categories of individual institutions can actually be zakat recipients, and defining what zakat need, for example, would be. But what we see based on some of those variations across different Muslim majority countries that we talked about earlier, is that there are these sort of key gaps in terms of how we understand the extent of state involvement in zakat and obviously its impact, the relationship between the way that zakat is administered and formal taxation systems. So how do people, for example, their own attitudes towards zakat and taxation, and how those differ, and then obviously another key aspect of it is the equity profile of zakat, both in terms of how it's collected and how it's distributed, especially during the crisis. Does it resemble or does it have the similar equity profile to other forms of charitable contributions that we see, or does it sort of take on the equity profile of more formalized taxation systems? Sorry. So just based on that, we sort of structured the research across a range of three sort of key issues and sort of a range of questions that we were interested in. This particular presentation is going to focus on some aspects of these questions that we've listed here. But broadly, we're interested in, again, the relationship between zakat of the state, the relationship between zakat, tax, and charity, and the relationship between zakat, the equity profile of zakat as a form of sort of obviously a voluntary or state enforced obligation, and its impact during the crisis itself. So the research design that we took, we decided to go with sort of analysis of three case studies here. We took on Egypt, Morocco, and Pakistan as those three case studies. They're broadly similar on a range of other sort of factors, lower middle income states that are broadly autocratic in terms of their political history and political development. The Sunni majority countries, and collectively they represent about 15% of the global Muslim population. What we do see where we have significant variation across these three states is whether the state zakat is mandatory by state law, and whether the state manages a zakat contribution program. So based on those axes of variation, we come up with this simple 2x2, where we have Pakistan being a sort of a case study where zakat is not only mandatory by state law, but the state actually collects and deducts zakat and has a state-run zakat contribution system in place. In Egypt, on the other hand, you have an example of a state fund existing, but it's not mandatory to contribute to it. Whereas in Morocco, it seems to have taken on a completely voluntary nature altogether, where the state it neither mandates the deduction of zakat, and nor is there the existence of a state fund itself. The data was collected just after Ramadan 2020, and we used Arabic and Urdu phone-based random digit dial surveys in all three countries for a total sample size of 4,569. These surveys were broadly nationally representative, and we oversampled an additional 1,000 respondents of zakat payers in Egypt and Morocco. We also integrated a list experiment to check for social desirability bias. Obviously, we're asking about questions related to both taxation, tax compliance, but also sort of voluntary contributions, which are questions that are susceptible to social desirability bias, as the literature extensively shows. So the existing sort of limitations with the way that the survey was designed, obviously, was that we had to sort of really reduce the kind of interesting questions that we wanted to ask because of the fact that it was a phone-based survey, but also that phone ownership and the gender distribution of respondents were also sort of key factors that came out as a problem in particular, especially in Pakistan, where we had a skew in terms of obviously who the with having far more male respondents than female respondents in our sample. Right. So just very quickly, I'll go over some of the key findings here in terms of, in particular, how zakat is conceptualized, which is sort of the first area that we're interested in focusing more on. What we see here is that from the data is that pretty much across all three countries, zakat is largely seen as personalized religious obligation. And if we look at the data that we've collected on both zakat payers and where did they pay zakat to, as well as sort of we posed a hypothetical where if you had to distribute $10 among zakat recipients, where would that go? The $10 were obviously converted into local currencies in all three countries. What is actually quite clear is that among all respondents, for example, people in the neighborhood, extended family, kinship, tribal group, so essentially personalized connections and networks are where people would largely direct their zakat payments and obviously zakat obligations towards. This is including in countries where you do have the existence of a state fund. In fact, Pakistan, where you have a mandatory contribution to the state fund itself, there is very little obviously support. There's, as the data shows, there's very little payment being made to that particular state fund. And even if we go with the hypothetical, people are generally unwilling to contribute towards the state fund in countries where you actually do have one. What's interesting is that there seems to be sort of a greater support for the state fund as far as Egypt is concerned, which maintains a voluntary state fund rather than a mandatory one. Similarly, if we move on, there is, so when we ask people and who they think should have primary responsibility to organize zakat, in Morocco, where there is no, where there's very little state involvement in the administration and collection of zakat, there seems to be a higher degree of support for more state involvement. In Pakistan, where there is sort of where we see the existence of state, both in terms of a mandatory deduction and the operation of the state fund, a plurality, however, and a majority in Pakistan, a plurality in Egypt believe that zakat should be organized by individuals themselves. Generally speaking, that seems to be the result. Across the board is that sort of a significant number of respondents do believe that individuals themselves should have the responsibility to organize a zakat itself, which is why we think that this really feeds into our sort of general notion that people see this as personalized religious obligation. And sort of the final thing that we would like to add on this particular way in terms of how zakat is conceptualized is the knowledge of how important it is to know the zakat recipient itself, which in Pakistan was obviously significantly higher than in Egypt and Morocco, where sort of people generally believe that it was not particularly important to know, whereas in Pakistan up to over 70%, just over 70% of respondents believed that it was that is very important to know who the recipient of zakat is. Just to sort of give some backdrop to this, the Quranic tradition in general defines 8 different categories of individuals that can be zakat recipients. There are obviously regional differences in which of those 8 recipients are stressed more as being more deserving of zakat. But what is quite clear is that there is a greater degree of focus on giving to people in the immediate neighborhood or giving to people sort of within the extended family. That much is fairly common, even across all different sort of theological interpretations of zakat itself. Then sort of this slightly sort of unpacking this relationship between zakat and the state itself. It seems that from the responses that we received on this question of what would make you contribute more towards a state fund for zakat, a lot of the responses seem to be channeling demands around accountability, transparency, and greater public participation. But we still have a sizable minority of respondents who remain unwilling to contribute more, regardless of how the administration of zakat systems by the state actually changes. So that too speaks about sort of prevailing attitudes towards seeing zakat as something distinct from what state enforced obligations or fiscal obligations might be. The relationship between zakat and taxation.
You have 5 minutes.
Yeah. The relationship between zakat and taxation becomes a little more interesting, I think, in this way. If it's a loaded question to ask in the first place, but when we pose this question to our respondents, 72% of total respondents chose that they would pay zakat over taxation if they had to pick one. This is a majority in all 3 countries pick zakat over taxation. Obviously, the number is slightly higher for Pakistan, which pushes the overall average up as well. there is a sort of a greater preference for tax payment. It increases by income levels in Egypt and Morocco once we start to unpack the data, but it actually moves in the opposite direction for Pakistan. So people who are at higher levels of income in Pakistan have greater preference for paying zakat over taxation, but it's the opposite in the other two countries. We believe that this might be tied to obviously levels of religiosity and personal belief systems, and that's something that our analysis hopes to explore further. Even so, we also had questions on asking whether paying taxes can be justified, or when is not paying taxes justified, and when is not paying zakat if that can ever be justified. And we had sort of roughly similar. So 57% respondents said that not paying taxes can never be justified, while 66% said not paying zakat can never be justified. In our sort of greater sort of analysis on zakat over taxation, we asked similar questions with regards to the ongoing sort of pandemic as well. If they were asked to pick one, 70% of all respondents said that they would opt to pay zakat instead of a tax in the context of the crisis. 53% of respondents think that it's more important than usual to pay the full amount of zakat during COVID, while the corresponding figure for importance of paying taxes during COVID is 35%. So people certainly think that that not paying out your zakat obligation is more of a problem than not paying out your taxation obligation, especially under COVID. And this is sort of, I think the figures somewhat similar to what was raised in an early presentation here as well. This difference is fairly there's no significant difference in preference across education levels in all three countries as far as this particular issue is concerned. So it's really zakat has sort of comes out as an important sort of at least people have certain views, or very strong views in terms of how zakat should be administered, especially during a crisis itself. Right, just to conclude, we again, just like I said at the start, this is fairly preliminary work, and we sort of obviously hope to produce much more richer analysis of this. But to our knowledge, this is sort of one of the first works that actually looks at zakat in the context of some of these important debates around the role of the state should be in obviously and the shape of the fiscal contract, as well as obviously what the role of charitable contributions can be in mitigating different types of crises. There are obviously ongoing issues in terms of how we study zakat. There is the issue of social desirability bias, and how, to what extent list experiments can help us account for it, or at least help us sort of assess it. There's also the issue of political context in Egypt and Morocco, and especially sensitivities were prevalent around questions related to trust in the state, trust in the fairness of the taxation system, trust in the fairness of obviously the state's ability to collect taxes, as well as to administer other basic health services. Those are some of the questions that we did pose, and where we feel that the political context makes them slightly more, it poses challenges for us in terms of understanding how some of those things might be interacting with the institutions of zakat itself. So yeah, so that's pretty much it from our end. I'd be very interested to hear comments and sort of questions as well. I think Max and Sukaina are both here as well, and feel free to jump in if there's certain responses you want to make. Thank you.
Thanks very much. I had asked Mashekwa if I could call on him first. I hope that's okay.
Oh yeah, that's fine. Thank you very much. This is a very interesting paper, quite fascinating, I must say. I note that firstly it's preliminary work, so obviously you're still working on it and the scope for improving this paper. And I have two general comments. Firstly, I note that zakat is quite large. I was actually amazed to learn that estimates show that total contribution to the treasury could be anywhere between $250 billion to $1 trillion. So that's very significant. And I thought you could actually build on that and use the two case studies of Pakistan and Morocco. Correct me if I'm wrong there. I think in one instance, you've got the state being fully mandated to actually collect and administer, and then in the other case, it's completely voluntary. I think that's in the case of Morocco. So I thought you could actually use those two case studies and just try and understand, the productivity in terms of revenue of these two setups. How does, for example, zakat contributions per capita differ in the case of Pakistan and versus Morocco? The whole idea is really to come up with suggestions of whether state mandated versus voluntary systems are more productive. And one could also do the same in terms of, if there is data, one could do the same in terms of the distribution of the benefits. Where is it more progressive? Yeah, is it in Morocco or Pakistan? Again, the whole idea is to try and draw some policy recommendations for that. The other question I had, which you might want to clarify in the paper, is, are there instances where zakat is earmarked? Is it for which specific services, or is it just social services in general? And especially in the context of COVID, is it that you've got payers specifying that take my contribution towards the fight against COVID, or could these contributions just go to general services like health and education and so on? So those are very broadly the comments I had. It's a very interesting paper, and I really look forward to the completed work so I can learn more. Thank you.
Yeah, thank you so much. Those are, that's very helpful, and obviously, those provide us with good fruitful directions in which sort of research goes forward. So the cases that that I think would be suited to the comparisons that you're making would be Pakistan and Egypt. Egypt is where you have a voluntary state fund, but no state mandated deduction, whereas Pakistan is where you have a state fund and obviously state mandated deduction. We are also putting together, Sukaina, who's also here, is putting together a global zakat data set. We're trying to sort of parse together as much data as we can find in terms of what overall voluntary contributions are, what state collections are across different Muslim majority countries. And we're trying to sort of come up with a typology of how these systems actually vary and what the productivity of each system is based on how much is actually generated and where, how much is generated and what sort of institutions actually govern zakat, the functioning of zakat in these different contexts. What's obviously slightly harder for us to sort of assess, and there's very little data on it, is the eventual distribution of zakat and where that ends up going, because a lot of it happens through personalized, as I showed in the data as well. A lot of it happens through personalized channels. A lot of it happens, with people actually knowing the recipient itself. So it's even in cases such as Pakistan, where you have obviously state mandated deduction, much of the actual sort of zakat is distributed through personalized channels rather than through the state itself. So the state collects zakat on it collects zakat largely through formal banking channels and assets that it maintains sort of visibility on. But most other people sort of generally tend to sort of give out their zakat payments on their own. So those are, again, some of the challenges in studying an institution, which obviously, just to echo something that I've already said earlier, which is something that is fairly prevalent, across a number of different countries in the global south, Muslim majority countries in particular. But there's very little data that we can use to actually assess some of these factors. So, our paper hopes to be sort of, partial contribution towards some of those questions. But just also broadly on your second point about where does the contribution actually end up going, towards disaster relief or relief during a pandemic, or towards other forms of services such as health and education. We have some sort of obviously data that we're hoping to build on, but those are some of the challenges that we continuously face when we're assessing something like this. But thank you so much for your comments.
Okay, thank you, Mashekwa. Are there any other comments from the audience on this paper in particular? Otherwise, I'd hoped we could, in the final minutes of the panel, just sort of draw some broad lessons or draw the strands together from the different papers that we've seen. Yes, Julia, go ahead.
Maybe in the spirit of sort of drawing some thoughts across presentations, one of Oliver's comments struck me when he said, these informal contributions are important, but they're little money. I'm simplifying, Oliver, but if the problem is getting to 15% of GDP to 25% of GDP in tax, then that's maybe not going to get us there. And that point stuck with me. So I actually made a note that this is something that we need to do a lot more, even within the CTD, to sort of connect the formal and informal tax work that we're doing. And that is something that I really liked about your presentation, Umer, because you really made an effort to do that. And you mentioned, so this is really more of a broad comment, there's no really question there, unless you have, I think you said at the beginning something about the comparison in the amount, so in sort of revenue generation between zakat and taxes. I wonder if you have any, if you want to maybe say something more about that in the specific countries you're looking at, or if you have a sense, so you know how the two compare in terms of actual revenue. Again, more of a comment than anything else, but thanks.
No, that's actually that's a really sort of important point, because I think one of the starting points that we made when we were developing our research design was to look at sort of formal tax capacity and using tax to GDP ratios to look at how sort of these countries vary across different zakat environments in Muslim majority countries, and that's part of the data set that we're also accumulating. But I can speak sort of slightly more confidently about Pakistan, where the tax to GDP ratio has generally hovered below 15%, especially over the last decade. But at the same time, sort of independent, assessments of zakat contributions would approximately sort of reach about 1 to 2% of GDP as well, 1 to 2, maybe slightly more than that, and that's on an annual basis. So that is, I mean, obviously it's still small when you compare it to the total amount of taxes that are generated, but it as an independent or one unit of within the largest sort of obviously fiscal contributions that people are making, it is quite sizable in nature. And again, a lot of it is being channeled through personalized sort of relations and sort of personalized networks, and that's obviously what adds a certain dimension or uniqueness to it as well. So I think that there's I think there's certainly scope to assess the additional role, not so much as a replacement for the way that sort of tax systems are generally supposed to work, but the additional role that these contributions can actually play in a range of different settings.
Great, thank you. Any other last sort of thoughts from any of the audience? Okay, well, then great. Thank you very much, everyone. We're ending on time. This has been a very interesting panel, and thank you for participating, and especially to our presenters and our discussants for their very valuable contributions to the session today.
Thank you very much, everyone. Bye-bye.
Thank you.
Yeah, bye-bye. Have a nice
Bye-bye.
evening.
Ciao.